What is the goal of the market? Let's look at a few things that we need to know about the market to sell premium and to sell a strangle in there. The primary goal of the market is to facilitate the exchange of goods and services between buyers and sellers through the merchandise of price discovery. In a market, buyers and sellers come together to exchange goods and services at a agreed upon price. The market helps to determine the price of goods and services based on the supply and demand on factors, and also provide a platform for competition between the different producers and sellers. So if we look at the market has been going up ever since it started. You might say, well, the market's always going to be going up. That's not necessarily true. Inflation has been going up at a rate, and so does the market need to go up on a rate. But when we look at the split between the market going up and down, we can see that between 1996 and 2016, the market went up 53.3% of the days, and the stock market was down 46.7% of the trade. So you can see that it's slightly skewed on the upside on the days and a little less on the downside. When we look at the updated days between 2016 and 2021, we can see that the market went up at a 54%, close to 53, close to 55%, while down only 45.1%. So what that means is we can see that the market is starting to go up at a higher pace more than it's going down. And that could include to a couple of things. That could be that inflation has increased more than it was, and also can result in a bunch of free money that we've been letting into the market the last few years. We can see that a little bit here. We can see that the bar chart is the QQQ, and that's the NASDAQ, and we can see this is on a weekly chart, and it is up pretty good amount since COVID happened. But if we look at the orange line is the equally weighted version of the NASDAQ, and what that means is that we are going to equal a percentage gain Microsoft and Intel, because they're two different companies valued at a very different amount. If there's we were going to equal a 1% gain in Microsoft is the same as a 1% gain in Intel. And if we look at that, the market's actually a little bit lower. So what this graph shows us is that the bigger companies have actually been growing at a faster pace and bringing up the market with them. But if we look at QQE, which is the equally weighted version of NASDAQ, the market has not been going up as much. And it has not had a peak the same amount as as its predecessor. You can see it had a peak of 95%, and we've only had a peak here about 60%. So it gives you a basic view of how the market's been going up and finding price. And we can see the same in the 1 week chart from 2012. When we look at that, we can see that the drops are less, but also the rises are less as well. And you can see that the market, since it is up close, almost double of what the equally weighted weight is. So it just shows you that the market is being dragged by a bunch of the large companies, and if we were to look at all the companies equal, the economy is not in the best state as it could be. And if we go back to what is the market, and that definition is said, it is to find buyers and sellers through price discovery. And what that means is that there's the market's in a range most of the days. And I've highlighted some of the ranges here, and 1 bar is 1 day, so you can see that in some of these cases we have spent a long time here. For example, this is where we're currently at, and we just spent about 46 days in the price range. We didn't go anywhere. And when the market moves and agrees upon moving on a price, it moves quickly. It does usually return or like to visit the same price points once in a while, so you have a chance to get out of a position, or you have a chance to get in a position. And you can see here that we decide to move quickly, consolidate, move quickly, consolidate, move quickly, consolidate, move up some more, consolidate. And pretty much what this means is inflation has a effect on us, because obviously people that were buying here, for some reason, were not buying here. So this is price discovery. All of a sudden, people thought that $400 a share was a deal. And then when it got here to about 370, 365, nobody was buying it. And nobody agreed on the price until it got to about $290. And you can see some people wanted to buy it here, some people wanted to buy it here, some people wanted to buy it here. And you can see that the price itself was consolidating. So when price consolidates, the market doesn't move anywhere, and you're not making much money if you're just holding on a share. So there's other ways to make money by selling strangles, selling option contracts to improve your ability to make money in the market. For example, let's take a look at 40 days, 48 days out on QQQ. And if we sell a 20 delta strangle, which means that this has a 20% chance of reaching this price. This is what the expected move is, and there's a 20% chance of reaching that price. And what that means is that the market cannot move up. The market cannot move down much further than it's expected based on the where it is right now, based on the price, based on what people are willing to pay, based on price discovery and agreed upon price. And if we sell a 20 delta strangle, a 20% chance of reaching 303 versus versus on the call side at 341, which the market right now is trading roughly around the 322 range, right? So it would need to move about $22 in order to reach this point. And we would be collecting on the put side, we would be collecting $21, and on the call side, we would be collecting on the put side, we would be collecting $2.37 per share, and on the call side, we would be collecting $2.37 per share. Yeah, and that would give us a total. If you multiply that by 100, that would give us a total of $570. And that would give us a strangle of $570. So we would get paid upfront $570. Now there's risk, there's unlimited risk here, but let's look at the trade ticket here. So you could collect you could sell a strangle closer to the money. Let's say you want to sell one that has a 30% chance of reaching that. You're a little bit more risk averse, right? You'd be selecting a 30 delta. You'd be getting paid about $482. So nearly another nearly $100 more per contract. And you could do the same thing here on this side, which we would be selling at 335. You get a $420 dollar per contract. And you could see that there are people that are selling those. And if you look at the volume, there's about 1,180 that were traded on Friday. And you can see here as well, 400. Well, it looks like they were selling the 310, 9,000 for 40,000, 9,400 on Friday trade volume. And you can see if you sold those strikes 341 and 303, we would be looking at a significant move here. And you can see I did a translation, I did a copycat of this right here, this move right here. And you can see that this move right here is 42 days. If we have something similar like that, it could take us 42 days to get to that point. And if we had a aggressive move like this, then we could take 20 days to get to that point. And you would want to manage this, meaning that if the market moved, let's say the market is trading at 322 right now, which it is, and let's say the market moved to $330, you would want to recenter your strikes probably once or twice a week to the new 20 delta, to the new 20, buy back your options and resell it at the new 20 delta. So if your delta went up, you would want to go ahead and move your strike whichever side to the new 20 delta. So if you sold at 322 and let's say it went to 330, you would move your your put to the new 20 delta, which would probably be somewhere around 310 area. And that would increase your possibility of making profit on that trade, and also it would reduce the chance of hitting that full max loss that you can't withstand. So there's a few ways to manage it. We'll talk about managing a strangle later, but this is just a general idea of selling at 20% delta. So, and when we look at the trade ticket, we would look at a possible full chance of winning at a 66%. The extrinsic value, which is our maximum profit, is $572. The percentage of profit at 50% is 83% or 84% roughly. And we would be collecting, our contract would be losing about $13.72 per day. So our value of our contract would be going down. And you can see that our value, which is called time premium and option pricing, is valued at a exponential curve. And at 90 days, the curve is very slow. So we don't necessarily want to sell 90 days because although we could collect money, the curve is so little that it's not collecting enough. So where you want to start selling is at 45 days. And you want to start managing it at 21 days. And the reason why you want to start managing it at those days is you can look at this curve right here. So at 45 days, your option price moves very slow, and it's not, the risk is very small. At 20 days, the option price moves more. So that's when we want to manage. We do not want to manage at lower. We don't want to keep the trade longer than the 5 days, because your option price is going to be exponential versus your risk. Yes, it has a faster decay, but we're not interested in a faster decay. We're interested in making money and not losing our butts. And you can see that the buying power of this trade is about $4,607. And the possibility of profit is at 50% is $285. If we manage at 21 days to expiration, that we would reduce the risk dramatically. We would reduce the risk by about 70%. Chance. This is not even considering us managing our trade, which we'll go over in another presentation, but this one is just selling a strangle. And our theta, which we'd be collecting per day, is $13.72, right? So if you look at the risk to reward versus the value that we put up, so at $285 at 50%, and we're putting 4,607 at risk, we would be getting a 6.2% return, right? That would be a 13% return if you let it go to full till the end, but that's too much risk for us to handle. And when we look at that, this is where we want to stay within the limit. And doing the calculations per year, you're looking at possibly making over 60% on a strategy like this. Let me know if you have any questions.